We are potentially seeing one of the biggest short squeezes we have ever seen before. Not just in Tesla stock, there's a fair bit of that going on, but really I'm talking about the broader markets and this rally you have seen in the Russell and the equal weighted S&P 500. I will go over the data behind this, what kind of short covering we have actually seen, what historically this can lead to, and what's coming next. Tomorrow morning, we have some pretty big events that will be important. So at the time of recording this video, the Russell 2000 has rallied about 11% in just the last 5 trading days or so. This is one of the biggest short squeezes we have seen in our markets ever. You're also seeing the equal weight S&P 500 hitting a new all-time high every day over that same time frame, and also the S&P 500 that is almost hitting a new all-time high every single day as well, including today. The momentum behind this short covering rally is insane. Even in the S&P 500 on a market cap basis, the headline S&P that everyone usually looks at, yes, that has went up as well, but not nearly as much as the Russell or the equal weight S&P. You've actually seen big tech trade sideways. Apple's done a little bit better. Others have done worse. It really hasn't been a Mag 7 kind of led rally. Now, you've actually seen the short interest of the S&P going down a lot as well. You've seen a lot of short covering in the S&P from 11.67% short interest of free float down to about 9.5% short interest of free float. That's a big move down in a short amount of time. So you're even seeing shorts getting squeezed on the S&P itself. Now, in the Russell, it's been a little bit more dramatic because you were starting at a much higher place with about 31.3% short interest of free float, and now you're down to 25.5% short interest of free float. This is the lowest you have been in the last 3 months. If we look at the last 12 months, this is the lowest we have also been in the last 12 months. So the short position in the Russell 2000, the IWM ETF, is getting small again. And that's just because so many shorts have gotten squeezed out of their short positions. And really this latest move higher in the Russell and the equal weight S&P is exactly what hedge funds and institutions were not positioned for. The strategy so far in 2024 has been short small caps, short equal weight S&P, go long S&P. Go long Mag 6, Mag 7. That strategy has stopped working. So to minimize the pain, these hedge funds and institutions have been selling Mag 6, Mag 7, really Mag 6. We'll leave Tesla out of that because Tesla's been doing just fine and doing well this whole time. But they've also been covering on their IWM shorts. Now, I think the bigger question is, what happens next? Now that you have seen the short interest on the Russell fall back to the lowest level in 12 months. Well, just to be fully clear, open, honest, transparent, I have not taken any profits. I don't like taking profits in long positions unless they get way overextended, and I'm heavily allocated to Tesla. I'm heavily allocated to small caps that have been doing well, and I think there can still be room to run here. The reason why small caps have been going higher recently is not just a tactical short squeeze, it's the reason behind it. CPI came in lower than everyone's expectations. It was something that you don't see all the time. Wall Street was expecting 0.21% for core month-over-month CPI. You came in at 0.06%, almost negative, almost in deflation. And this has really solidified the odds of a rate cut by September now at 100%. There's a 100% chance, according to the markets, we get a first rate cut either in July or September. There is over a 60% chance of 3 cuts this year. That would be September, November, and December, getting a rate cut at each of those Fed meetings. At the same time, today you did have retail sales that came in better than expected. Last month's number was revised from 0.1 to 0.3%, and we came in line with the estimates of 0%. But considering last month's revision, the 0% number is even stronger than it would have been otherwise if we did not get that upward revision. Now, if you look at retail sales excluding autos, that came in at positive 0.4%, much better than what Wall Street was expecting of 0.1%. So inflation, basically not a problem anymore, almost in deflation territory. The economy doing better than expected, that's a good backdrop for small caps. But David Rosenberg says, if you were rubbing your eyes as I was over that retail sales report, I think I found the answer. A very generous seasonal adjustment factor was at play. The raw NSA data actually showed retail sales plunging negative 5.6% month over month in June, the worst drubbing in a decade and tied for the steepest plunge since the series began in 1992. Lies, damned lies, and statistics. So how strong is the actual economy? Well, not that strong. It's another smudge that the government does to make the data look a little bit better. And I mean, you can't blame them. It's a pretty important year. Same goes for the non-farm payrolls that were overestimated by almost 800,000 jobs last year, and many other data points. This is not a rumor. This is factual. If you actually look at the data itself for retail sales, you were very negative. Now, the point in me saying this is not that the government's rigging everything, in which, you know, they might be. The point of saying this is eventually the data will start to catch up if it truly was that bad. And I think that's a bigger risk over the coming months. Now, I think in the near term, from a purely technical kind of standpoint, I show this in almost every single video. It is the percent of stocks trading above the 50-day moving average because it shows you how strong the markets are. If you have a lot of the markets, a high percent of stocks trading above the 50-day moving average, that means the markets are actively in an uptrend. Now, typically when you start to get to super high levels, that's a time where you might want to think about selling some stocks, taking some profits. Whenever this number is really low, usually that correlates to a correction. It correlates to a crash in the markets. Now, recently you've been very low. That was because Mag 6, Mag 7 were leading the markets higher and basically nothing else was doing anything, which was pretty abnormal. But now we're back to 74.5% of stocks trading above their 50-day moving average. I mean, you can run into the 80s, into the 90s before you need or typically do see a larger, corrective phase. But you're starting to get up there. And it's starting to get to the point where maybe you should think about a little bit of risk management if you do have profits in some trades specifically. Now, again, I own a lot of small cap stocks. I own a lot of Tesla that's kind of grouped in that small cap, category because it's interest rate sensitive. I'm not selling any stocks here. Let's be honest. But if I did have calls on the Russell, I would be taking some profits. That's for sure. Or even calls on the S&P or the EcoWeight S&P for that matter. In fact, Jason Gopfert on X says it's pretty rare to see the S&P with 8 straight gap up opens, even rarer to see it continually record new highs during that streak. And on average, the median return, let's say 2 months later, is down about 3% for the indexes. The median return 6 months later is positive 5.7%, and the 12-month later median return is positive 16.4%. But you could see a lot of the times this happens right before you do get corrections or crashes. Right before the pandemic, back in 2016, back here, during the correction of 1998. Sometimes you see them like here, like 2014. Boom, you got one. Here was this 2018? You got a little bit more upside and then a slight correction. So not always doesn't mean you're doomed, but it does tend to correlate with right before a correction. It's also being reported that asset managers are now long $300 billion worth of U.S. equity index futures, the largest long position in history, according to Goldman Sachs. Now, this is one of those things as well. When you start to get to these levels, when you start to hit new highs relative to history, it does tend to mark some moments of pullbacks, of corrections, sometimes crashes. You could see back in 2018, the history we had before that, I mean, that was a new all-time high at the time for positioning in these, bullish U.S. equity index futures. And you got a correction in 2018. It was a pretty rough December, if you remember 2018. Around Christmas time, yeah, it was a pretty sharp pullback. Same thing happened. That was early 2018. You got a little correction during then. And then same happened late 2018. That's right here. And then 2019, you had a very good market. Positioning continued to get higher. And then what happened? 2020, boom, came crashing down. Same happened throughout 2020 and 2021. You went to a new high, and then you had 2022. That was a very rough year. And now it's been a little choppy, right? The correction that we've seen towards the end of 2023 lowered the position a little bit. Now you're way back up to all-time highs at much higher levels than you were before. This just means people are bullish. But when everyone's this bullish, it usually opens the door up for false realities or false expectations. When stocks just continue to do well and nobody sees downside risk, usually you can be blindsided during those moments. And I think if we are going to be blindsided, it's probably going to be from earnings, because earnings expectations are so elevated. Just since last quarter, you've rallied about 15% on the headline S&P 500. You're pretty much priced for perfection. Now, could we get perfection? Of course, but when you have retail sales data, the actual NSA data that is coming in negative over 5% month over month, it doesn't look great. But I wouldn't be surprised if this quarter earnings are okay, but some of the guidance numbers for next quarter start to come in on the rough side. And when markets are based on future expectations, that's not exactly good news for markets. Now, also, I would like to draw your attention to these wicked end of the day sell-offs that we have seen recently. This very much reminds me of 2022, where you would get markets that would be volatile, that would go up, and then sometimes would just give it all back towards the end of the day. That's what has happened the past 2 trading days, besides today. So today you did not see that. But when you look at what was this? The 12th, that was Friday. You kind of went straight up for most of the day. You had one real pullback and then just sold almost all of it off towards the end of the day. What happened yesterday? You gapped up, you rallied, you came down, you rallied again, and then sold it all off towards the end of the day. Hit a new low for the day. This is showing heightened volatility. But you're starting off the day strong. Now, today, you ended up rallying into the close of the day, so perhaps that's just investors getting ready for earnings, these bullish expectations coming out. I don't know, but it does tell me we can probably expect more volatility, more down days in the coming weeks. And let's be honest, we haven't had a real correction since that late 2023 correction, and it's July, okay? We should welcome a correction in a bull market. They're healthy, they happen, and they give you a chance to kind of flush out the bad behavior and to reward the companies that deserve it, and can be a good opportunity to buy the dip. The Kobisi letter on X kind of sums this up pretty well. They say the current situation: 1, tech stocks are falling like we are entering a bear market. 2, small cap stocks are rising like the bull market just began. Number 3, gold prices are rising like we are entering a recession. 4, bond prices are falling like the economy is strong. 5, oil prices are falling like rate cuts are canceled. Number 6, the S&P 500 is rising like rate cuts already began. Nothing adds up here. And I think that pretty accurately describes what's going on in our markets. Fundstrat's Tom Lee thinks we could get a 40% or more gain in small caps over the coming 10 weeks, and that the S&P may actually be negative during that period in time. He's actually saying that you could just see a continued rally in small caps and nothing happen in the S&P, which typically this only happens at the end of bear markets. When you see these kind of massive outperformance in Russell names, you see this in 1980, you see this in 2000, you've seen this in 2020, you've seen this in March of 2009. but yet the S&P is at all-time highs, literally today hitting a new all-time high, and it's not the start of a bull market. It's maybe late cycle bull market, but you're seeing this outperformance. Now, I do think all of this context is important because we are going to start getting more important earnings. Tomorrow morning will be very important with ASML. They are seen as one of those important AI stocks. They are a European company, so they will report earnings sometime overnight tonight, in the morning. They're scheduled for pre-market, but a lot of the times these European companies report like 3 o'clock, 4 o'clock in the morning. So don't be surprised if these numbers come out then. And they're like a $400 billion company, so that's not a small company. They will give us a direct insight to what to expect from TSMC, from other AI stocks that will have a pretty material effect as well, I believe, on your Super 6 names, your Apples, Googles, Amazons, Microsoft, Apple, Nvidia. And depending on ASML earnings, that can definitely set the tone for this earnings season. Now, you also have Johnson & Johnson, Allegiance Health, Ally, and a bunch of other banks tomorrow morning. Wednesday and after hours, you have United, Alcoa, Discover, Kinder Morgan, Crown Castle, Steel Dynamics, and others. And then Thursday is going to be your biggest day with TSMC, Nokia, Cintas, Domino's, others. And then in after hours, you have Netflix, Intuitive Surgical, and PPG that report tomorrow in after hours. Also, Discover and American Express, I think, are important to judge just how the consumer is spending money. Discover is tomorrow in after hours, and then American Express is Friday pre-market. Now, I still think a correction is coming over the next couple of weeks, but I don't think that needs to be negative for Tesla. I don't think it necessarily needs to be negative for small caps as well, because they have been so beaten down for so long. This is a short covering rally. But when you also look at the valuations in small caps, the Russell 2000 is trading at 10 times 2025 earnings, the median stock in the Russell. So if we're saying, you know, Nvidia trading at 25 times or 30 times 2025 earnings is a good deal, well, small caps are expected to grow anywhere from 25% to 89% per quarter for the next 2 years in their EPS growth. So 10% or 10x for a PE multiple for 2025, still very, very cheap. And that's just because small caps have not gotten any attention for a long time. Tesla, again, as I said in the beginning of this video, was kind of grouped in that category because it's so interest rate sensitive. And as long as the economy holds up, I think these areas can continue to do well. Now, if we even think about the term correction, that means to correct, right? To correct something that perhaps went too far. The areas that need correcting, I don't think are the Russell. I don't think are Tesla. And I think during a simple correction, based probably around earnings, it's going to be Super 6 stocks. It's going to be some healthcare names that have rallied way too much. But mainly your high-flying tech stocks. That's my expectation. Now, do I think the Russell is going to continue to have 3% days if we do go into a correction? Probably not. But do I think the Russell needs to correct more than the S&P? Do I think Tesla needs to correct more than the headline S&P? No. For context, if the S&P falls 12% and the Russell falls 4%, I wouldn't be surprised. And that would be a relative outperformance. Same is true with Tesla. Tesla's very volatile. It tends to have a very high beta, around 2x the S&P. So if the S&P goes up 1%, Tesla tends to go up 2%. If the S&P goes down 1%, Tesla tends to go down about 2%. It wouldn't surprise me if you get a more 1-to-1 ratio here. It wouldn't surprise me if the S&P falls 10%, Tesla falls 10%. Just for a rough ballpark here, that could put Tesla stock back to about 230, 231, 232 or so in that area. That wouldn't surprise me if that happens. And I think if you're someone that wants more exposure to Tesla, that would be a great buy the dip opportunity, because I believe after Tesla's earnings on July 23rd, you're probably going to get another rally in Tesla. because I think Tesla's opportunity to unveil these new models and what their pricing might look like, what they're actually going to look like, is probably this earnings. If not this earnings, next earnings for sure. But I think this earnings, since Tesla is forecasting some of these models by the end of this year, beginning of 2025, now looks like an appropriate time to introduce that. And it would also help this momentum continue instead of getting the typical, Tesla post-earnings sell-off. So for those reasons, I think it makes sense for Tesla to give us those new products this upcoming quarter. And then you're going to have the Robotaxi event. Who knows, August 8th, October. I know some people say, yeah, it's postponed for sure. We have not gotten actual confirmation of that. Elon's just said we wanted to make some adjustments and didn't really confirm whether or not it's actually delayed or not. So I would also be prepared for Tesla to announce that it's still happening on August 8th. I don't think you can rule out anything at this point, but if we want to make a more comfortable bet, if it does happen in October, I think that leads to new all-time highs for Tesla by the end of this year, because that's going to put AI on the radar for big money and what kind of dollars we can start to expect from AI, which is different from any other company. Any other company buying these GPUs, spending billions of dollars each quarter on them, they really don't have a path to monetization of that. They're trying different things, but nobody's really monetizing AI the way Tesla is. So when the markets move past the GPUs, NVIDIA's, ASML's, these other companies that are providing the GPUs, when the hype leaves those areas, it's going to enter into who's providing real-world AI, who's actually using this AI. And Tesla's number one on that list. And I think that probably happens by the end of this year and helps more investment flow into Tesla. And then even from the standpoint of new, cheaper models from Tesla, Wall Street's going to start looking at that and say, hey, maybe Tesla breaking into the $25,000 area, $30,000 area, with the tax credit maybe cheaper, Tesla can start to address an even larger market. Maybe there's an SUV. It looks like some kind of larger SUV could be in the pipeline for Tesla as well. And these things open up a new demographic for Tesla, a new consumer base for Tesla, and could start to add to deliveries. That should make estimates go higher, and that should make Tesla's stock go higher. So these are kind of my rough expectations for the next couple of weeks, and I wanted to put all this out here because tomorrow morning's earnings with ASML will be very important for that AI trade for the next couple of days, or at least days, but maybe next couple of weeks for the S&P 500. Hit the like button as well as subscribe to the channel. Let me know what you think about this information down below in the comment section. Check out the links down below in the description of this video as well if you guys want to join the trading community. Nonetheless, you guys have a great rest of your day, and I will see you in the next one.